let's talk about why stocks gap down or go up a lot when companies report earnings. So many investors come up with target prices on companies based on their future estimates. And for example, let's say that an investor expects earnings to be $5 a share in 5 years. And that investor thinks that the company should trade at 10 times earnings in 5 years. So that means 10 times $5 in earnings, which results in a target price of $50 in 5 years. Now, when companies report earnings, investors take the financial statements from the earnings report and they enter in details from the financial statements as fast as they can in their financial models. And if the financial statements are worse than expected, then in the investor's financial models, in 5 years, that $5 in earnings goes down. And if it goes down, for example, from $5 to $4 in earnings in 5 years, then the investor thinks that in 5 years, the P multiple of 10 times the stock will lead to a target price of $40 and not $50. And so the general rule that often works is that if a company reports earnings that are, let's say, 20% worse than expected, then that means that investors' target prices will also go down 20%, and therefore the stock gaps down 20%. Similarly, if a company reports earnings, and let's say they beat by 30%, then you might see the stock gap up 30% as investors update their numbers in their financial model. And so this explains why stocks gap up and down a certain amount around earnings. So how do you value a company based on earnings? Well, historically, the S&P 500 trades at 15 times earnings. And if a company is growing faster than the S&P, then that company trades at more than 15 times earnings. If a company is growing slower than the S&P, then it trades at less than 15 times earnings. Let me add one more level of logic to this. So the average company in the S&P 500 has earnings historically growing at 15%. So if the price earnings multiple of the average S&P company is 15, and we divide it by the growth of 15%, then that means a price earnings to growth rate of 1, a peg of 1, 15 over 15. If a company is growing earnings at 20%, then it usually trades at 20 times earnings. If a company is growing earnings at only 10%, then it grows at 10 times earnings, right? That's a simple rule to use. It's not perfect, but it'll help you understand valuation.